Hello, I'm John Holcomb. Welcome to Monetizing Innovation. Today we have a great guest. Haren Bhakta is the founder and CEO of the Inside Ownership Index, the first index fund designed to track performance of companies with meaningful insider ownership. Built on the belief that true ownership matters, the index aligns investors with long-term incentives of people running the businesses, keeping trust in the owners. Haren, thank you so much for being here today. I think it's going to be a really good conversation.
Yeah. Thanks, John. Thanks for having me.
It's my pleasure. I'm really curious too. In terms of the work that you've done, building the Inside Ownership Index, around the idea of ownership that matters. What was broken with the traditional index investing that led you to create this model?
Yeah, I'll tell you that story. But first, actually, let me tell you about the amount of data I had to collect to create this index. So when I first thought of the idea, I went to all the data providers like Bloomberg, Terminals, Cap IQ, FactSet. I went to every data provider to get this data of insider ownership and how far back I can go. And they all had incorrect data. So I had to go to every proxy filing for every S&P 500 company for 21 years. So that was over 20,000 different documents I had to actually physically go through to pull out the numbers. This is how much I did. So I'm the only one with the data currently. Now it's there, it's in the proxies, but no one had bothered to put it in some kind of database. So I'm the only one with it currently. Going back to your question about, how I came up with the idea or why or what was broken. So I'm a big Berkshire fan and shareholder and a huge Warren Buffett and Charlie Munger follower. And I bought a lot of Berkshire Hathaway because of them. And I bought a lot for my clients as well. So I've been attending every Berkshire meeting since 2017. And I wish it was sooner. I wish I got into them sooner. But anyway, it was 2017. And Charlie Munger passed away in late 2023. 2024 was the first meeting without Charlie Munger. And so I was there in person, sitting there. In the back of my mind, I was thinking, what happens when Warren Buffett dies? What do I do with my shares? I bought Berkshire because of him. I don't know, what the future holds without him. I'm kind of reassured that he's currently in the office 5 days a week. But anyway, I'm sitting there actually kind of afraid and in the back of my mind. And at some point during the meeting, someone asked Warren Buffett a question about index funds. And that's when it hit me. So the S&P 500 will actually, and most people don't know this, okay? The S&P 500 will actually buy more Berkshire Hathaway shares when Warren Buffett dies. And why is that? The S&P is what's called free float adjusted, meaning they exclude his shares because they're controlling shares. So he, as a controlling shareholder, S&P excludes those shares from the calculation of size, even though the size is truly $1 trillion. But if he owns, say, 200 billion, they're only counting 800 billion. And I thought that has to be the opposite direction. We should want more Berkshire while Warren Buffett's there and less so when he's gone. And the same thing goes for any company. I'll give you the best example is Tesla. So now imagine for antitrust reasons, Elon Musk has to decide whether he wants to focus on Tesla or SpaceX. Say the government says, you got to pick one. You can't have both. And he decides to sell Tesla and focus on SpaceX. This is not impossible, right? Now, the S&P will actually have to buy more Tesla shares. Now, there's no way Tesla could be, as valuable absent Elon Musk, right? So his 20% of Tesla would be sold and become free floating shares, ultimately leading the index to buy more Tesla. Now, again, it's the opposite direction. We want less Tesla without Elon Musk, right? So these academia got it half correct. So index funds have performed really well because a small group of companies have produced largely all the gains. This is a professor in Arizona, University of Arizona State, I believe. 2018, he published an article. He went back 100 years. He looked at every stock for literally 100 years, and he figured out that only 4% of all stocks in the US produced all the net wealth creation, and the other 96% produced returns equivalent to treasury bills. So 96% of all stocks matched treasuries, while the other 4% created all the wealth. So when I say academia got it half correct, Now, due to power laws, those 4% produce all the gains, but humans and leaders produce even bigger power laws. So just think about the average corporation and, what those extreme winners look like relative to the average corporation. Now, look at the average leader that's produced all this wealth like Warren Buffett, Elon Musk. Now compare them to the average person, and that disparity is much larger. So we should be indexing to the leaders and not to the corporations themselves, which is how I came up with the inside ownership index. So we're literally indexing to the leaders of the corporation and not to the corporation themselves.
That's such a great concept too, because like you said, that you're really focused on the value creation and where it's coming from so that you are.
Exactly. Now you think about a corporation filled with people and it's highly successful. Now you go and replace that entire company with new people. Is it really the same corporation? Well, the S&P 500 will treat it the same, but my index, based on leadership, treats that company differently. Now it's not the same company without the same people.
Yeah, and I think that's a great question too. When you look at some of that and you have some of those leadership changes, especially some of the large companies, right, that have operated for 100 years. When you look at that, what are some of the patterns you've observed, especially with like the ownership and what that actually did for those companies?
Yeah, well, every single super successful company I could find
Mhm.
started with a leader and ownership. In fact, there's a term called 100 bagger. 100 bagger means a stock returns 100 times your money. So $10,000 becomes over 1 million. Now, I went back 25 years from today. And there's about 19 companies that produce that 100 bagger. And I looked at every single one from where they started and what that company looked like prior to achieving that 100 bagger return. And every single one had ownership. Now they didn't want not necessarily a founder. It doesn't have to be a
Mhm.
founder. So for example, Warren Buffett is not the founder of Berkshire. Even Howard Schultz is not the founder of Starbucks, but they were the owners. And it takes ownership to really produce those really large returns. Those power law returns come from owners. And when those owners step away, you see the cultures erode and the performance decline. To give you a perfect example of today, look at Nike. Nike's a world-class brand, but you got Phil Knight retired. I can't remember exactly when. It could be like 5 years ago, but Nike stock is down like 50% from 2020, while the whole stock market is up enormously since COVID. Nike has struggled, and this is due to the culture of an organization erodes once those top leaders are gone.
Yeah, and I think that's such interesting insight, right? Because you see the culture, how important, especially that strong leader really is.
Yeah. Yeah. Starbucks is another example. Howard Schultz retired and he's no longer on the board. And you can see Starbucks stock struggling. Now, there's a few other companies where the leadership, the chairman and CEO kind of retired, and Reed Hastings with Netflix. So he just retired from the board. So he's no longer overseeing Netflix. And now we'll probably see Netflix's culture erode. Now, it's not a fast moving thing like next year Netflix is going to die. But the point is, it no longer has that ownership and leader at the top to set the standards. Now, when you have a board filled with no ownership and you have a mediocre CEO, there is no mechanism to really replace that mediocre CEO. Now, with passive index funds like the S&P 500, who invest significant money in these companies with no ownership, they become the largest shareholder. And those shareholders are basically ETF purchasers, and there's no one voting anymore, essentially. There's no one there to replace either a mediocre CEO or a even sometimes terrible CEO. Now, a terrible CEO is a little bit easier to get rid of. Warren Buffett talks a lot about the value destroyers over long periods of time are really the mediocre CEOs because there's just no mechanism to get rid of them. And they're often the highest paid CEOs. So the owners, the super value creators, we call them, are actually the lowest paid CEOs. Steve Jobs, I think, took $1 salary and the rest was stock options where he had to hit numbers to get it. But you look at the highest paid CEOs today, and they're the ones that don't own any of the company.
Yeah, and I think that's just such an incredible insight that I think with your research that you've shown that. Yeah, and as you looked at building your index, I know that was like no small feat. What were some of the biggest challenges that you were able to do to turn this idea into a credible, investable product?
Yeah, well, when I was in Omaha and I thought of the idea, like while I was sitting at the
Hmm.
meeting, I had to come back. I came back from Omaha. Getting the data was really tough. So I had to go to every data provider to see where I can get this ownership data. And just nobody had it. To give you an example, I went on a Bloomberg terminal. I looked up the ownership of Netflix in 2010, and all the shares of Reed Hastings, the founder, were in a trust. And so for whatever reason, it doesn't show up on these platforms. So I was just frustrated. I had to go and figure out a way to get all this data, and that just took so much time. So I thought of the idea in May of 2024. The index didn't go live until November. So I had to spend about 6 months just getting all that data and figuring out how to launch an index. So I actually contacted numerous index providers, and I ended up choosing S&P. So even though I'm a competitor of S&P, they're the actual ones that calculate my index and publish the returns. So when you go to my website, side ownership.com, and you click on performance, the performance actually links over to S&P, which publishes my returns. So I mean, it couldn't be a better partnership, really, where I'm competing against S&P and they're the ones also publishing my results.
That is kind of a
Yeah.
interesting turn of fate, right?
Yeah, and it's not my results. It's just the 100 top owners in the U.S., right?
Sure.
So it's a completely passive index, and the idea is that it's a better way to be indexing than the typical index fund, which indexes the corporations, and we feel indexing to leadership is better. And the history shows the same result, where it is in fact better.
So from your perspective, when you try to apply what you've learned now, right, to then new companies as they emerge, has it gotten any easier to find some of that data, or is it still just as difficult, especially as you're trying to track, right? Things.
Yeah, well, yeah, you collecting the new data ongoing is a lot easier. Now, I had to go back 21 years, and a lot of this ownership data didn't exist before 2004. So I could only launch the index with the inception date of 2004. I
Okay.
tried to go back 30, 40 years if I could, but that ownership data just doesn't exist. Those proxy filings are nowhere to be found. So I just could not do it. So, but ongoing, this process is a lot easier. So some of the index providers, I'm sorry, some of the data providers are starting to provide it. I still use the proxy filings manually, but it's just a lot easier now that they are all there laid out for me, versus I had to really go digging deep to find some of them. Some of those companies don't even exist anymore, right? So imagine a company either went bankrupt or got acquired. So their proxy filings are just very hard to come by.
Yeah.
But I went further back than 21 years. For the index, I went back 21 years, but to get an idea of how this would have performed for the last even 150 years, we could look at the top 10 constituents going back that far, and we could see the top performers, and every single top performer had large ownership. I looked at IBM. IBM in 1984 was the largest company in the world by a factor of almost 3. So that would be like Nvidia today being more than probably a $12 trillion company today. The dominance IBM had was even larger than what Nvidia has today. And they were the darling of Wall Street, right? So peak 1984, that was IBM top one in the world by a factor of 3. It's forward just 8 years. In 92, IBM was not even in the top 10. So what changed? In 1984, founder's son, Mitch Watson Jr., which actually is the one that took IBM public in the first place in the 60s. So he was the CEO in the 60s. He's the one that wrote it all the way up as the chairman of the board up until 1984 when he retired. He retires at peak IBM, 1984. 8 years later, not even in the top 10. So all that lead and competitive um, advantage, lost just in 8 years. It's crazy, and IBM is not even top 25 anymore. So this is what happens when those responsible for the the innovation and the lead are no longer part of the company, those companies' competitive landscape erodes. So innovation is really what's called tacit knowledge. So tacit knowledge is what it's called implicit knowledge. Knowledge that can't be just taught to the next person. It's like ingrained in their bones. They're the often the ones who created that initial product in the first place. So they're just close to the ground. They know it inside out. They can't just teach the next person. So this is why you can't just hire a great leader. Those great leaders typically don't exist, right? Now, there's a few counter examples to that. For example, Apple. Apple has continued to do well absent Steve Jobs. But Tim Cook didn't invent anything new, right? So, the iPhone is iPhone. It might improve by speed, but it's still the same iPhone, right? Pretty much. The next leg of what's to take place, I would not count Apple in to participate in that. I mean, they're not even trying. And I think they are making the right move. Now, they don't have the talent to go and, predict what's going to happen in AI, and they should therefore stay out of it. But then you got people like Mark Zuckerberg spending hundreds of billions of dollars, but he does have that talent. So we want him. So Apple and Meta, while they're making exactly the opposite bets, they're making the correct bets for the talent they have. But if you want to bet in the future, you want to bet on these people who have that knowledge, that implicit knowledge of what may to come.
Yeah, I think that's so important. I've even seen that in private companies, right, where you see the generational transfer of leadership, and with each transfer, right, you kind of move further and further away from that.
Exactly.
Yeah,
Exactly.
I think that's such great insight, and I think about for investing, how incredible is that, right, to actually bet on the winners,
The bet
especially.
on the winners,
Yeah,
yeah, the leaders, and not just the corporate winners, but the actual winners within the corporation themselves. There's a great book written by Matt Ridley. His book is titled "How Innovation Works," and he talks a lot about how innovation really works from feedback loops. So good ideas must survive and bad ideas must die. And the problem with low ownership companies is those feedback loops are so large. It's so hard for these mistakes to be brought up through the layers for upper management to see them. But these high ownership companies are close to the ground. They have the tighter feedback loops and they're able to make adjustments and fail early. And that's the idea is having what Nassim Taleb calls tinkering. You have to tinker and fail small. And when you're able to do that, that's when the true innovations happen, is that the good ideas win.
absolutely, and
Yeah.
especially when you think, right, 90 to 95% of, all new products fail.
Exactly.
Just
And
say
you
fail.
can look at Apple and Amazon and compare those differences. So Apple and well, Amazon has huge failures, they have billion-dollar failures, but that's actually a good thing because they're trying new things and failing. The big winners succeed enormously. AWS, for example. I mean, Jeff Bezos created two world-class companies. A lot of people don't talk about that. He didn't just create Amazon, the retail store. He created AWS. And, that comes from a side project. So Apple has no failed projects, right? Because they just don't take them. So for them to come up with what the future holds, I don't see it happening.
Yeah, no, that's so true, right? Because, even some of the early founders, in addition to Jobs, right, a lot of those have moved on, like, Tom Wozniak and some of those guys too. So
Exactly.
you don't have the same horsepower there, so I think it's a great point. And I think that fundamental, like you said, ownership state, it does really shorten that feedback loop.
Yeah, yeah,
Yeah.
exactly. You got to show in that feedback loop. You got to fail early and you take small bets, numerous small bets, and you just keep going and you fail small, and then the extreme winners take care of themselves. It's a power law. It's the same thing as investing in people. It's the whole power law function.
Yeah, I completely agree with you. I think it's so powerful, especially with you sharing the work and building your index off of that. It really is a nice, almost like statistical comparison, right? To show how
Right.
important this ownership factor is to the successful companies and therefore the financial profits.
Exactly. And my index doesn't work in every market. So I'll explain that. My index, the inside ownership index, works in areas where power law is a big part of the returns. So in areas where it's not, an inside ownership weighted index will probably not do as well. So I'll give you an example there. Okay. Energy. The energy sector has two winners that have been the winners for 100 years. So you have ExxonMobil, and Chevron. They've
Mhm,
been the winners for 100 years. So there's been no innovation, no changes, no extreme winners in the energy field or industry for the last, 50 years at least. So another one is communications. So AT&T and Verizon have been the winners for 100 years. So there has not been a function of the power law within those industries. But you look at the technology industry, that is where the power law really is magnified, right? And the inside ownership index, if you just take the technology sector, which is also on my website, also published by the S&P,
mhm.
and you compare that to the S&P 500 technology only sector, and we outperformed by an even wider margin. So in areas where the power law is very important, using ownership will, at least in the past 21 years and probably 100 years, has produced much larger returns.
And what a just incredible find, right? And I think being able to research that, build an
Yeah.
index around it, I think that is so powerful.
And the amazing thing is, like, I came back from Omaha looking everywhere for it. I thought this has to exist. Somebody had to have come up with it. To my surprise, nobody has. Nobody has created an ownership index. There's a few other, not even similar things, but they have maybe a similar title. So there's a couple ETFs out there that track insider buying.
Mhm.
So almost the opposite of what I created. So these large ownership companies, the best performing companies have large ownership, but the insiders are actually selling. Jeff Bezos has been selling Amazon for 20 years. Jensen has been selling Nvidia for 20 years. It's not that they're selling because they're bearish. They're selling to get liquidity. Liquidity.
Right.
99% of their net worth is tied up in that stock. So them selling is not a, bearish signal. And some of these other ETFs trap buying, which is completely opposite. We're not tracking the buying. We're not tracking the activity. We're tracking the ownership and the dollar value of that. And really how much it represents in their net worth. So when you're a CEO of a company and 99% of your net worth is tied up in that company, you're going to treat that company really well. You're not going to go for short-term results. I actually have a t-shirt on. So it's nicknamed the Skin in the Game Index,
I,
based on the fact that they own so much.
Yeah, I love that because I think that applies to whether it's a large corporation or small companies, right? It's that really that personal connection, that strong ownership stake, because like you said, it really closes the communication loop. They are much more hands on versus aloof, right?
Exactly. I mean, Elon Musk is on the ground.
Yeah.
He's talking to the actual engineers doing the job. And problem with these other companies is, management, they're not engineers and they may know how to manage people, but they don't know where the problems exist with the actual technology. So it's like the layers of people before these bad messages get filtered through there. By the time a problem reaches them, it probably sounds like a good idea. Every layer actually lies to the layer above them. And that's just how bureaucracy works. Everyone is kind of softening the blow or the mistake as it moves up the chain. And when you have 18 layers between the CEO and the actual person working on the problem, it just gets lost. Innovation is so slow. And that's why Elon Musk's companies innovate so rapidly, right? I mean, yeah, the speed of which they're able to make changes compared to the speed of the most common company is crazy.
Absolutely. And you look at what he's done with SpaceX, right? And just that, the amount of failures that they've had, but each one's been their learning lesson. That's how they
E
propelled further. Uh,
Exactly.
and it's amazing because they can operate in a different way than the big defense contractors can because of all the bureaucracy and all the, everybody wants to take that safe bet versus, really
Yeah.
being able to drive and learn.
Yeah. And the mindset of these owners is actually what sets it apart. So I'll give you an example. So with SpaceX, so the industry standard for 100 years, literally, was a rocket launches up, and when it's done, it lands in the ocean, and that's it. Those rockets are not reused. He thought, well, what if we just land these rockets on their butt and reuse them? So he collapsed the entire cost structure of rockets by a factor of 10. So he reduced the cost down to I'm sorry, 10% of the original cost. So, asking a hired manager to think outside the box, to come up with these, they're ingrained in the box they're given. And while these owners are able to think completely outside the box, they're
And
not forced into a system.
absolutely, and that's so powerful, right?
Right. So
Uh,
we want to overweight our positions with index funds to these creative thinkers, these super value creators. And we end up with a more concentrated portfolio, but we end up with a better, higher performing portfolio. And the interesting work I've done is that while it's more concentrated and more volatile, now we looked at two time periods, 2020, COVID-19, and 2008 financial crisis. Those are the two global catastrophic events we faced in the last 20 years. Now, the high ownership companies went down less so than the average S&P 500 company. So it had lower drawdowns. And that's because these higher ownership companies are better run. They're more innovative. They're able to change when the world changes faster. And, so while it's more concentrated and academia may call it more risky, but when you need that safety the most, it's held up better.
I think that's so fascinating, right? And that correlation with the ownership, really just goes to show how powerful, some of these stocks can perform, especially when they're under the great leadership and ownership and folks have stake in the game.
Exactly.
Uh,
Yeah.
I have to admit, Heron, this has been such a great conversation. I'm so glad that we were able to connect today and have some of these discussions. Is there anything you'd like to make sure you leave with the audience to make sure, if there's anything we haven't covered or anything I haven't asked yet?
Yeah, I have a website that people can go check out. It's very simple. It's insideownership.com. I have a 2-minute explainer video in there that kind of explains the methodology of the index itself, and they can get a better idea of how it's built. So I would recommend anyone to go and check out that 2-minute video just to figure out how it works. And I have some brochures in there with more information. Happy to talk to anyone who wants to talk. They can reach out to me through the website.
Fantastic. No, and I really appreciate your insights and the innovation that you brought into really exploring this path. I think that's fantastic.
Thank you. I appreciate your time and having me on your podcast.
No, absolutely. And I'll look forward to hopefully having you on again here soon.
Awesome. So then the ETF goes live in like 2 weeks. So maybe that would be maybe next month or two. That'd be a great time to be back.
Absolutely. We will definitely do that.
Yeah. And by the way, the ticker symbol for the ETF is going to be OUN.
Okay.
Yeah.
Pretty easy to remember, right? Yeah,
Yeah.
exactly.
Very easy to remember.
That's fantastic. I'm excited for the progress, and it's going to be great. Hopefully, some of the viewers will reach out to you after seeing this episode.
Awesome. Thank you.
Thank you.